According to recent data, 1 in 3 Americans does not have an emergency fund. The median amount Americans have saved for emergencies is just $500. That is less than most people's monthly car payment. And it is actually down from $600 just a year ago. Meanwhile, these same people are asking whether they should buy individual stocks or invest in cryptocurrency. Here is the devastating mathematical reality behind that decision. The average credit card interest rate in America reached a record high of approximately 22% in 2023. The S&P 500 has historically returned approximately 10% annually. That means carrying credit card debt while investing in the stock market is mathematically guaranteed to make you poorer, not richer. Because your debt is growing at 22% every single year while your investments are growing at approximately 10%. You are losing approximately 12% every single year on every dollar you invest while carrying credit card debt. Today we are going to show you the exact sequence of financial decisions that must be completed before investing a single dollar, in the mathematically optimal order that most ordinary people never follow, because nobody ever clearly and honestly showed it to them before. Before investing a single dollar, every ordinary person must build an emergency fund. Here is exactly why with real data. According to research by Vanguard, people with at least $2,000 in emergency savings had financial well-being scores that were 21% higher than those without any emergency fund. That was the largest boost linked to any single financial factor they measured. An emergency fund is not just about having money for unexpected expenses. It is about creating a psychological safety net that prevents you from making terrible financial decisions when life inevitably throws you a curveball. When your car breaks down or you face an unexpected medical bill, having an emergency fund means you do not have to sell your investments at the worst possible time or rack up high-interest debt to cover the expense. Start by saving your first $1,000 as quickly as possible. This covers most minor emergencies and gives you an immediate psychological safety net. Then work toward 1 month of living expenses. Then build until you reach 3 to 6 months of expenses. According to the Bureau of Labor Statistics, the average American household spends approximately $5,111 per month, meaning a fully funded 3-month emergency fund requires approximately $15,333, and a 6-month emergency fund requires approximately $30,666. This money should be kept in a high-yield savings account earning approximately 4 to 5% annually, where it is immediately accessible when you need it. Not invested in the stock market. Not kept under a mattress. In a high-yield savings account where it is safe, liquid, and earning something meaningful while it waits. Once your emergency fund is in place, the next step before investing a single dollar is to eliminate all high-interest debt. And when we say high-interest debt, we mean anything charging you more than approximately 8% annually. Credit card debt is the obvious villain here. With average interest rates over 22% in 2023, credit card debt is the single most financially destructive force in the lives of ordinary people. It grows faster than almost any reasonable investment return you could expect, which means carrying credit card debt while investing is mathematically guaranteed to make you poorer. Here is the data that proves exactly how devastating credit card debt actually is. If you have $5,000 in credit card debt at 22% interest and make only minimum payments, you will pay nearly $2,800 in interest over 5 years. That is $2,800 that could have been working for you instead of against you. Every dollar you use to pay down that debt is essentially earning you a guaranteed 22% return, which is better than Warren Buffett's long-term average annual return. The strategy for paying off high-interest debt efficiently is straightforward. List all your debts with their interest rates and minimum payments. Pay the minimums on everything. Then throw every extra dollar at the debt with the highest interest rate first. This is called the debt avalanche method. And it saves you the most money mathematically over the entire repayment period. Total American credit card debt reached a record high of approximately $1.13 trillion in 2023. At an average interest rate of approximately 22%, that represents approximately $248 billion in annual interest payments from ordinary Americans going directly to bank profits every single year without providing a single additional product or service in return. Here is the one major exception to the rule about paying off all debt before investing. And it is so important that it changes the entire sequence for anyone who has access to it. If your employer offers matching contributions to your retirement plan, you should contribute enough to get the full match even before you finish paying off high-interest debt. This might seem counterintuitive, but the math is compelling and completely undeniable. Employer matching is essentially a guaranteed 100% return on your investment up to the match limit. Even if you are carrying credit card debt at 22%, getting a 100% immediate return makes mathematical sense. Here is a typical real-world example. Your employer matches 50 cents on every dollar up to 6% of your salary. If you earn $50,000 annually, contributing $3,000 to get the full $1,500 match represents a 50% immediate return plus whatever your investments earn over time. No other investment opportunity can guarantee that kind of return. The key is to contribute just enough to get the full match. Then redirect all your extra money back to paying off high-interest debt. Once the debt is gone, you can increase your retirement contributions significantly. According to Vanguard, approximately 25% of employees who are eligible for employer matching do not contribute enough to receive the full match. That is approximately 24 million ordinary Americans, leaving billions of dollars of completely free money on the table every single year. Simply because nobody ever clearly explained to them that capturing the employer match should come before almost every other financial priority. Once your emergency fund is built, your high-interest debt is eliminated, and you are capturing your full employer match, the next step is to maximize every tax-advantaged account available to you. Because the tax drag on a regular taxable investment account can cost you hundreds of thousands of dollars over a lifetime. Here is the data that proves exactly how powerful tax-advantaged accounts are. If you invest $10,000 annually for 30 years in a tax-advantaged account earning 7%, you end up with approximately $944,000. In a taxable account with the same return but paying taxes on dividends and capital gains along the way, you might end up with closer to $700,000. That is a difference of approximately $244,000 just from tax drag alone. The three most powerful tax-advantaged accounts available to ordinary Americans are the Roth IRA, the health savings account, and the 401k. A Roth IRA allows ordinary people to invest up to $7,000 per year in 2025 with completely tax-free growth and completely tax-free withdrawals in retirement. A health savings account allows ordinary people to invest up to $4,300 per year for individual coverage in 2025 with triple tax advantages: tax-deductible contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. It is the only account that gives you tax benefits on the way in while the money grows and on the way out. And a 401k allows ordinary people to invest up to $23,500 per year in 2025. Between these three accounts, ordinary people can potentially shelter over $34,800 annually from taxation, allowing significantly more of their money to compound without the government taking their cut every single year. The math on health savings accounts alone can be absolutely stunning. If you max out HSA contributions for 30 years and achieve a 7% annual return, you could have over $400,000 in completely tax-free money available for medical expenses. Given that the average couple retiring today will spend over $300,000 on healthcare throughout retirement, and HSA can essentially make those costs disappear from your retirement budget entirely. Once you have built your emergency fund, eliminated all high-interest debt, captured your full employer match, and maximized every tax-advantaged account available to you, then, and only then, does it make mathematical sense to invest additional money in a regular taxable investment account. Taxable investment accounts offer complete flexibility. You can invest in individual stocks, index funds, ETFs, or almost any other financial instrument without contribution limits or withdrawal restrictions. But they come with a significant tax drag that makes them significantly less efficient than tax-advantaged accounts for long-term wealth building. For most ordinary people who are working through the sequence for the first time, the reality is that they will never get past the tax-advantaged account stage. The average American saves approximately 6% of their income, which is typically not enough to max out even their employer match and IRA contributions, let alone their HSA and full 401k. But following this sequence consistently and completely, even if it takes years to work through each step, produces dramatically better financial outcomes than the approach most ordinary people take, which is to invest randomly in whatever seems most exciting at any given moment without any clear understanding of the optimal sequence that maximizes returns while minimizing risk and tax exposure simultaneously. Here is the confirmed optimal sequence for investing your money in the mathematically correct order. Step 1. Build an emergency fund of 3 to 6 months of living expenses in a high-yield savings account. Step 2. Eliminate all high-interest debt, especially credit card debt charging over 8% annually. Step 3. Contribute enough to your employer retirement plan to capture the full employer match. Step 4. Maximize your Roth IRA contributions up to $7,000 per year. Step 5. Maximize your health savings account contributions up to $4,300 per year if eligible. Step 6. Maximize your 401k contributions up to $23,500 per year. Step 7. Then and only then invest additional money in taxable investment accounts. Following this sequence will not make you rich overnight. It will not give you the excitement of picking the next hot stock. But it will give you something far more valuable than either of those things. It will give you a mathematically optimized financial foundation that compounds quietly and powerfully in the background of your daily life, growing stronger every single month. Until one day you look at the numbers and realize that the boring steps you took years ago have built something extraordinary.